Hey everyone, welcome to the Slice of Finance podcast. I'm your host, Jared Taylor. Joining me today is the founder and CEO of Frec, Mo Adham. Mo, how's it going?
Hey, good to be here. Thanks for having me.
I'm excited to have you here. I saw one of your announcements a few weeks back, and you'll talk a little bit about that shortly. But I'm like, oh, we have to have Mo on. So I'm glad that you agreed, and let's do this thing. I guess first, I'll start with the question I usually ask in case anyone's not familiar with Frec. You're wearing a sweatshirt with the logo on it. Someone says, what is that? What does that company do? What do you tell them?
Yeah, so basically what Frec does is Frec lets you get market returns through index investing. And sort of like on top of that, we get you tax savings, right? So it's almost an evolution of an ETF, right? If you think about passive index investing, it started out like back in the day in the format of a mutual fund, but mutual funds were very, very tax inefficient, right? And then sort of the next evolution from that was an ETF, and ETFs made it better. It was a massive tax advantage, right? And then sort of like think of direct indexing as sort of like the step above that. So it gets you plus or minus the same returns as an ETF, in addition to some quite significant tax savings and tax advantages on top of them. As in addition to like personalization benefits, right? If you wanted to, have the S&P 500 minus Meta because you work there, for example, this is a vehicle that can allow you to get that.
Oh, that's interesting. Yeah, that's a really good. There's so many times people want to get into an index fund, but there is certain areas they don't like, and then in the past they had to suffer through those companies maybe that they didn't want. Or it's interesting with some of these index funds, you'll see there's like three companies driving. This has been the case for like the last couple of weeks, right? Like we've had or last couple of months, we've had so many companies at the top of these index funds that are driving all the value, and then the rest of them, are slacking. But I did want to ask you around the direct indexing. You mentioned a little bit, but how this differs from traditional index investing and why you view it as a game changer for the everyday investor.
Yeah, totally. So, first of all, I should say that this is by no means a new strategy. This has been around for decades now. If you talk to a family office that's managing a lot of money, like call it 500 million plus, they have their public equities exposure in the format of a direct index. They have moved on from ETFs a long time ago, and they're using direct indexing. And so the big difference between using a direct index versus an ETF is that a direct index passes down to you as an owner, capital losses. So these are think of them as credits or potential deductions against your tax returns. And the way they've described it to me when I was doing the listening tour before starting this company was, hey, this is a shield against future capital gains, right? So they will collect these capital losses so that they can protect against future cap gains, because obviously a family office is also investing in private equity as well, and they're like LPs and venture funds and so on, and those investments produce cap gains that will be offset by the cap losses. So that's kind of the big difference. You get the same returns as an ETF, right? There's a plus or minus a tiny tracking error that is pretty much a solved problem. But you get, in addition to that same returns, you get these capital losses, and you get quite a bit of them. You get almost 40% of your investment back in cap losses over the course of 10 years. So if you invest, just to put that in perspective, $1 million into an index fund like, for example, VTI or something like that, you'll get the obviously total market returns, right? But with a direct index, you get those same returns in addition to 40% of that investment back in cap losses, or $400,000 back in cap losses over 10 years.
Interesting. And I mean, I will say this, like what you were saying earlier about that this is not necessarily new, but the way that you have addressed it, and also kudos to you and the brand and everything. I mean, your site's beautiful. Like you did a really good job for everyone to have an opportunity to work with you. Those other ways were kind of closed off, right? Before, like unless you had so much capital that you couldn't even work with them at all. So one of the things I'd also love to talk more about is another one of your key features being portfolio lines of credit. How do you see this product empowering investors, and what challenges did you face in making this offering both accessible and secure?
Yeah, well, the really interesting thing about this product is that people want to know that it exists, but they don't necessarily, have a strong need for it right away. But if someone wants to invest a lot of money in a direct index, they want to know that if they need access to that money one day, that they don't have to necessarily sell their investment to use that money, which could be for a temporary purpose. Like a lot of people, for example, may want to buy a house, all cash, and then sort of like refinance it later into like a mortgage or something like that. Or they may want to like, fund like a home renovation or something like that, right? And so they want to know that this access to a line of credit against their portfolio is there, right? And so we built this product actually to, initially the funny story is that it was the first product we built. We built it before direct indexing. We wanted to make sure that it was in place, it was functional, it worked well, it addressed some of the basic needs that people had, and then we built direct indexing later after. And then obviously, the rates are high right now too, right? I mean, we're hopefully on the precipice of the rates coming down over the next couple of months. And once they do, I think that would sort of like open up the doors to more borrowing against assets, which is another thing that is sort of like family offices and other really wealthy individuals do, which I think should be accessible to everyone else as well.
First thing that's going to come to mind when people, like those that haven't heard of Frec before, is it's going to come down to, okay, so let's talk me through some of the differences between this and robo advisors, right, is one of the things. So customization is obviously, as you mentioned, is a key differentiator. Can you walk us through, Mo, how you enable investors to, you mentioned it earlier, but I'd love to dig deeper, personalize their portfolios, and what kind of feedback have you received from users on that feature?
Yeah, so we have a lot of customers in different sort of like they have different needs, right? One of the most common ones is like, hey, I already work at Nvidia or at Uber or at Meta, right? I don't need to sell my RSUs at Vest and then take that money and then rebuy into the same thing that I just sold, right? It makes no sense. So I want to buy into the S&P minus Nvidia or Meta or a handful or a basket of names that they already own, right? And so that's sort of like one strong use case. Another one is just a values filter. People have different values. They may want to like remove access or remove exposure to certain sectors or certain types of companies, right? And again, like I think those types of customizations are like the cherry on top. And I think that for most people, the main value prop is the tax savings, right? I mean, that's sort of like arguably the best selling point of the product, right? In terms of how we differ against a classic robo-advisor, remember those products were built back in 2010 and so on, right? So think of them as like maybe an older generation of what we're building today. And so they do tax loss harvesting, but they do it in a very rudimentary way. They will buy one ETF, then when the ETF goes down, they'll sell it and buy another ETF, right? And then sort of like swap you between ETFs. But in many cases, sometimes what happens is an ETF could actually be in the green, like it can be up, 0.5% or 1%, but underneath the surface, there's a lot of stocks that are moving up and down, and if you own the ETF, you'd have no opportunity to harvest any losses. But if you own the individual stocks, which is what direct indexing does, we unpack the ETF and buy the stocks within it, right? Then you have the opportunity to tax loss harvest at the stock level. And so TLDR, what that means is that you double the amount of losses you can harvest with a direct index. So with a platform like Frec, you're getting double the tax losses harvested at less than half the cost of a classic robo-advisor.
And we need to talk. You probably hate hearing about this, but I have to ask because
No.
it's not a podcast nowadays if you don't mention AI. So, you obviously leverage AI for a lot of these automations. How do you see this evolving? Like in fintech in particular, right? How do you see AI continuing, not just for your business? Obviously, I can see even more use cases beyond where you're at today, and that'll continue to grow. But just for the fintech space in general, how do you see AI impacting it across the board?
There's a ton of areas where they're sort of like they're that are ripe for, I think, uh, solutions that are powered by AI, right? One area that we use today is we use a few vendors for compliance, right? Like someone wants to publish a marketing piece or a blog post or something like that. Traditionally, what used to happen a couple of years ago is you have a chief compliance officer who maybe, and there's a few people that work for them, and every piece has to go through compliance reviews with feedback incorporated into it, and you have to capture the entire like workflow of that, right, in a system like Jira, and then have it all documented for the SEC exam, right? There's a ton of regulation, and so in these regulated areas, like if you're an advisor like we are, right, then there's a lot of requirements for you to keep a clean record and follow a certain process, and so AI like helps quite a bit with that, right? Because we just sort of like have an automated system that can read the piece that's about to get published and leave feedback and maybe suggest the changes themselves, right? So that just makes us faster, right? Instead of a piece taking 3 weeks under review, we can take like maybe a day. And then there's obviously product areas as well. Anywhere from the value filters that I talked to you about earlier today. It's an idea we're super excited about, but we haven't really, sort of like made much progress on it yet. Is if you come in and tell us, hey, I want to invest in the S&P 500 minus companies that are contributing to the microplastics pollution that's happening, or XYZ, any other custom filter that you have in your own, sort of like set of values, then maybe Gen AI can help with that as well. It can help you sort of like research your ideas better, give you the right links, validate them, and then suggest for you the companies to exclude or include in your index. So the possibilities are endless. Obviously, I can speak more smartly about our own use case, but I'm sure every other kind of fintech out there is thinking about AI as well.
Yeah, I'll tell you, the compliance piece brings up some scar tissue with me. 'Cause, like, I worked at Fidelity years ago, and we had to, if ever we wanted to make a trade, we had to get it approved before then. But half the time, that by the time they approved it, it might have been a couple days after where there was a big opportunity. I remember I tried to buy. It was this company. They made like catheters and different devices, vascular something out of Boston. And they competed with like Boston Scientific and things like that. And at the time, it was actually going to be a sizable investment for me, like early on in my career. But I really did my research. I liked the company, and they didn't. They said they couldn't because they had like a fund or something that was invested in it, and they declined it.
Oh, geez.
Uh, and then I remember taking a screenshot of when it went up over the next 6 months substantially and sending it back to. They don't care, right? But it was just a. But the fact that that could have happened, at least even if it was a no, go look at the recent holdings, say that you can't do this because of this reason. Like that was a person though years ago, and now it
Right.
doesn't have to be necessarily, right? So that's really interesting, huh?
Yeah,
Yeah.
no, there's a lot of these kinds of use cases that can be unlocked now. Just like increasing speed, increasing efficiency, reducing kind of the amount of hops that are needed to like review something or give feedback. It's amazing.
I want to make sure we bring this up because this is how you and I first got connected. Was when the news came out that you hit 100 million in customer assets within only a year of launch, which is super impressive.
It's actually 9 months, but yeah.
Oh, 9 months, even better. Oh, gee, even more
We
impressive.
take credit for the extra 3 months. Yeah.
Yeah. Oh, wow. Well, first off, again, kudos. Like that's a huge accomplishment. What's next in terms like what's on the horizon? Are there any new products you're particularly excited about that'll be coming out? Obviously, I know you can't share everything with us, but I guess what can you share in terms of what's next?
Yeah, totally. So yeah, we're very excited about the milestone. We did some digging and just to like try to benchmark ourselves against some other folks in the space. And for example, I think we found some kind of an article that from the Wealthfront early days where they were at like 67 million 12 months in. Betterment took them about 2 years to get to 100 million. So the team is quite stoked about hitting the 100 million 9 months in, and I think we got there by being very focused. A lot of fintech companies, I find, sort of like try to do too many things. It's very easy to have a portfolio of products, right? Because customers are asking you for a billion things all the time, right? And so what we did differently was we like really sort of like narrowed in on direct indexing, and we went really deep there. And so our plan is to continue to invest even further into the direct indexing product, making it even better, making it like more feature rich, more feature complete, and so like addressing all the edge cases around it, adding more indices, making it accessible through a mobile app, etc. Like there's a lot for us to do there, but we don't plan to like have like the kind of app that lets you do everything, right? And so we want to be just specializing in direct indexing and do it really well, and eventually even introduce other asset types into the offering.
I love it. I love it. Well, I'm excited to stay up to date with what's happening and what's new. And again, congrats on all the success so far. I'm glad you told me 9. I had that wrong because that, and you know what? When it's 9 instead of 12, you always tell people because that makes it even more impressive. It is not easy what you did. So, Mo, I'm super excited that we were able to connect and chat some more, and obviously look forward to future conversations with you. Um, actually, I had one more question before you go, even though it's still fairly early. What's something that happened at the very beginning that made you want to cry, but now you can laugh about?
That's so funny. It's a good question. I you know let me think. Let me take a minute to think about this, because there were definitely some difficult moments at the beginning, right? Yeah, maybe I'll mention this one thing. We did kind of have like before launching, right? Like we launched in October of last year. A few months before that, we were still in beta and we were trying it out. And I had set up my account, for example. We had one angel investor in our company use a product, like it a lot, move significant funds into it. Like it was like high six-figure amount into it, and the team was stoked. Like this was the first time we're getting like a big customer who's like not an employee. And then maybe a couple weeks later, because of some missing features that he had asked for, kind of got disgruntled and like moved out. And the team like moved the assets out basically, and the team was crushed. You can imagine, right? Like the first was a big moment of celebration followed by a big disappointment, like we screwed this up type of thing. And frankly, like I had to call someone on the team that was on the operations side and kind of talk about it, and they were very disappointed. I still remember like how sad they were that this person left. And then like now I look back at it, and over the past week this customer has come back actually, and we're very happy that he did. But I think we might have overreacted the first time in both kind of the ecstasy that came from signing up the first person, and also the sort of like the disappointment after they left, because ultimately it's one customer, and this company hopefully will serve hundreds of thousands, if not millions, of customers down the line. So over indexing on these like first 10, 20 people, it's important, right? But I think the lesson for me is not to take it super seriously, because stay focused on kind of the long term and how we're going to have hopefully thousands of customers, and not to like get overly sort of like analytical on what happened there, right?
I love it. Yeah, every time I ask that question, people go, "You just want one instance that made me want to cry." Yeah, it's one of my favorite questions to now ask, because usually there's a spark that happens in someone's eye when it's asked. So thank you for your thoughts.
Yeah.
Yeah, Mo, it's been an absolute pleasure chatting with you here today. Can't wait for future conversations. And again, wishing you and the team all the best of luck.
Thank you. That was awesome. Yeah, really appreciate you having me.